contact info is here, so you'll be able to have that for after the presentation then too. So really it's just, you have to dive into, there's various different types of reporting based on what kind of entity you are. So some of you are sole owners, so that's just going to hit your Schedule C. You don't have a separate tax return you do, you're just going to do your personal return, and that activity gets reported on your personal return. A partnership, and there's LLCs that are treated as a partnership, which is a very common like pen ownership situation for startups. This is, you're filing a Form 1065, which is a partnership return, and this provides K-1s to all partners, and this means that the business is not paying the tax. The partners of the business are the ones who will pay the tax or get the loss. So it's everything from a partnership goes through to the partners. And I know a lot of partners are sometimes surprised by this when they're new into an LLC. Like, oh, wait, we didn't have income, and how am I getting taxed on this? So this is when the strategic planning really has to come into play for startup companies where you are a partnership. So you really are, we're figuring out that you're not going to get taxed on things that truly is not like income at this point. And then there's S corporations, which are also sometimes an LLC treated as an S corporation. And it's very similar in terms of there's a filing for the business, which is the 1120S, but that provides K-1s to the owners. So it goes through to the personal tax return again. There's not actually tax at the business level for federal. Sometimes state can happen at the business level for any of these. And then there's a C corporation, which that's all the tax happens at the business level. There's no pass through to owners. So there's those various types of entities. And just the basic, the due dates for this year, April 18th for 1040s and for corporations, but then the partnerships and S corporations are due March 15th for the fact of they have that pass through that has to go on to a personal return. So you want that time in between. Any return can be extended for another 6 months. The thing with extensions is if you do have a profit, you just have to pay the tax with your extension. So April 18th, and then you can actually file the return. But the nice thing is if you have a loss, then you can just take the time to actually file the return, since a loss won't require any tax due. Now, the big question is that I get from startups is, do I actually have to file a tax return? I mean, I haven't had revenue. I have a loss. Like, we've just been spending money. We're not making money. The answer is yes, you do have to file a tax return no matter what. The minute you have your registration with the state, or you have an EIN from the IRS, you really should be filing tax returns because they know you exist, like you are a business. If you literally just form the company and there's nothing happening whatsoever, like not a single dollar is spent, partnerships, I mean, you can get away with not filing a return until you actually have the activity happening. But really, I mean, the second you're spending money, even if it's just that you're having expenses, you're not making money, you're putting the money into the business, or maybe you get a grant or something like that, that all does justify needing to file that with IRS. But I mean, there's a positive to that, in that when you're building up these losses, they can be used against future profits. So if you're not filing with those losses, then you're not building these losses up to offset your profits in the future. So there's a big benefit to that. And apart from the fact that it's required, it's just a benefit that people don't even realize that they're missing out on, building up these losses that are valuable. Another benefit is if you are in a KIZ location, which something like Pennovation is, I know science centers, and just anywhere. I mean, I'm sure there's places in Pittsburgh that might be, you do need to have a tax return filed to establish like your base year. So it does comparative years. So it's very important for that aspect too. Even we've filed a zero return for a company who was officially formed, but they weren't doing anything yet. We have filed a zero tax return so they could establish that year, that the next year when they have activity, then they'll be eligible for credits and everything. So there's a lot of different values in just filing a tax return. Does anyone have any questions on that? Oh, great. Okay, so what should I gather for my business return? The big three things that came to my mind are obviously financial statements. So to get financial statements together, a balance sheet is reporting your assets. Most of the time, it'll just be cash for a startup company. If you have any receivables in terms of you invoiced people and they haven't paid you yet, you'll still have that reported. Any bills you have that you haven't paid yet, any loans you have, and just how much money you have put into the business or taken out of the business. All of that stuff is important for tax returns, and that's really the essence of what makes up a balance sheet. And then the income statement really just reports everything that you've gotten in that is for sales of products or services, or if you've gotten grant income in. And then all of your expenses. So, a lot of times an income statement at this level will be pretty expense heavy and not really any valuable revenue that you feel like. Maybe the money you're putting into it is just funding the expenses, or you get a grant that'll fund some stuff. So it is very important to see all of those expenses that you've had for the business. And I know I would say this somewhere in the future, but now's a good time to point out, even like you spending money out of pocket for the business, maybe the business is not paying that yet. It's still valuable to be reporting that information too, because you can count that as contributed to the company, or it could be something that the company will eventually pay you back once they have the money to do so. So it's good to still get the expenses related to that as well. And that's the thing that a lot of people kind of miss. And then ownership information. It's easy when you're a sole proprietor, so you're the only owner. But then once you get into the realm of being a partnership or an S corp, it's very important to just always keep an operating agreement and any amendments that you have, and provide that to whoever's going to do your tax return. So if you have this ownership now through March 1st, and then a new partner enters, and then they're going to be in the company for the rest of the year, that actually does get split out for tax reporting. So it's very important to have all of that documented and to know. Okay, now just some basics in terms of financial statement reporting. This is a part that people really get tripped up on sometimes, in the fact that there's two main forms of how you report your financial information. So the first is cash basis, where you're just reporting your income and expenses as the money is transacted through the bank account. So if you have a bill that you received that was December of last year and you didn't pay it until January of 2022, this is a 2022 expense because you paid the cash happened in 2022. Contrarily, accrual basis, this means that everything is recorded as they are earned. So if you have a bill for services that were performed in November of 2021, that's going to be reported in November of 2021, no matter of when you actually paid it, because this really shows like what is actually happening in your business in terms of like actions and like the work that happens, versus cash is just totally based purely on when things are paid and not. So some people see value in different ways. At a certain level, you have to do accrual. Accrual is what an accountant would feel is the appropriate accounting methodology, but there are just some businesses that just make more sense to be on cash basis. A lot of like medical fields where there's crazy billing stuff happen. Once crazy stuff gets involved like that, there's times where cash is just makes more sense. And obviously it is easier too, since it's just reporting what happens in your bank account. But those are two very clear, like it needs to be a decision made, what is your accounting basis, and kind of following that. And you can get strategic either way. So there's strategies that come into place when you're on a cash basis versus an accrual. There's definite strategies between the two of them. And here's just some like major expenses that come to mind that are like the key ones that you just think of as an accountant automatically to tell people in terms of tax reporting. So meals is the common one people know about, where it's business meals are, even if it's a true total business meal. They're only 50% deductible. There's certain situations that are 100% deductible. I mean, if we have like meal that's for our entire firm at my accounting firm, it's offered for everyone who works here, then that's something that's 100% deductible. So little things like that. But for the most part, meals that happen within a business, whether you're meeting with a potential new employee or a potential new client or some kind of network person that will help your business, those are all going to be mostly 50% deductible. For owner payroll, this is another thing. To get an owner paid, it really is based on what type of entity you are. You just can't take money out and you can't just go on payroll. Like, it varies per entity. So for a sole owner, you just take a draw from the company and that gets reported on your balance sheet. It's not treated as an expense at the end of the day. And then you will end up paying tax on that because it's not reducing your total expenses, income with expenses. So you just take that money out. A sole owner just set up as a sole proprietorship really should not be on payroll to get the taxes out at that point. You should just be setting the tax aside as you're going. An owner of a partnership is paid in the form of guaranteed payments. When you are an active partner and actively working in the business, then you would technically have a salary. Your salary is in form of guaranteed payments. This is just, you would get like your $10,000 a month or whatever it is. And there's no taxes taken out of that. That will get reported on your K-1 and then you'll pay taxes, but it is reported on as an expense for the company. So it will decrease the company's bottom line. So it does show up as an expense. You also have the opportunity to just take distributions out, which shows up on the balance sheet, but that's like the less formal version. If you really aren't just working in the company full time and very systematically, sometimes partners just take out distributions as they need it. I mean, you can also take out distributions to help you pay your taxes and all. So there's different forms. The partnership's a little more flexible on how you can take money out. When you are in ownership of an S Corp or a C Corp, you can actually go through payroll and you have to go through payroll for your payroll within there. So this is the times. There's some people who just want to be on payroll. So an S Corp makes more sense to them than a partnership. There's some more stringent items with an S Corp, whereas in a partnership, I said you can take distributions out sometimes if you just need something to pay your taxes, like that's possible. In an S Corp, anyone who takes distributions out has to take them out in the same amount of their ownership. So like if you have Joe and Bob who own 50-50 of this company and Joe wants to take out $10,000, then Bob has to take out $10,000. You can't just someone take money out and someone doesn't. So it gets a little more systematic once you're in an S Corp. And then a C Corporation is just you're on payroll and that's what you are. I mean, you may have dividends, but that gets a little crazy and probably not worth it for our conversation. And then how I mentioned before, another big thing is out-of-pocket costs. I think a lot of people leave out and lose out by not paying attention to money that you've actually put into the business that really does add value to all that sweat equity you're putting into the business. Like you can actually get deductions for you putting money into the business. So really make sure you're keeping track of that as well. And it really plays a story into the history of your company too, to see how much money was really spent on these costs to get this business up and running. Does anyone have questions on expenses? Because that is the basis of the tax items I had for a tax return. And then I will go into 1099s, but if anyone has questions right now, we could do tax ones at this point.
Can I ask a question that I haven't bothered to look up or ask anyone else about? If you send a check out and you're using cash-based accounting, you send a check out at the end of the year, the person receiving the check doesn't cash the check. So you account for it in your initial tax year when you send the check out. They contact you in the next tax year and say they lost the check and ask you to reissue it. In cash-based accounting, do you have to go back and correct the accounting, or do you just have that replacement check count as the previous tax year? Sorry to be so.
Oh, no. That's totally fine.
That.
Yeah, so it would count. So pretend you did this December of 2021 and they didn't do anything with it. So, and you would have counted that in your 2021 accounting. So then if you are going to like void that check now and replace it, those two should cancel each other out in 2022. So like your void should create a reversal per se, and then writing the new check should create the new check. So those end up zeroing each other out, because at this point you have that old check as an outstanding item. So you kind of need to cancel out that outstanding item and put in the new one. So it won't hit 2022 for you at that point. So that is key though, to make sure you are reversing so it does not hit 2022.
So the expense though stays on 2021.
Yep. Any other questions? All righty. Okay, so now this is about 24 days late, but it's never too late and good for planning for 2022. So 1099 reporting basics. 1099s are the bane of my existence. I will actually say that. We do a lot of 1099s for our clients, and those are due on January 31st. So we have 1 month to do a lot of 1099s. So what happens is anytime you pay anyone in your business to perform a type of service for you, and this includes a business or an individual. This is where people like totally have this wrong a lot of times, where they're like, oh, I just have to pay a person and that counts. Businesses count too. So if you have a business that's performing services for you in excess of $600 for the year, then you have to issue them a 1099. So what you should be doing is anytime you're about to get into a business relationship with a new vendor that's going to be doing any type of service for you, you should request a Form W-9 from them right away, because you will need their name, EIN, or social security, their address, and that fills out their entity type too. So the entity type is important because, of course, it's particular in who you actually have to issue a 1099 to. So if their entity type is an individual, a partnership, or an LLC that is treated as a partnership, then you actually send a 1099 to them. If it is a corporation, you do not need to send a 1099 to them. So the tricky thing is an LLC could be basically any type of entity. So if someone has LLC in their name, you have no idea if you need to issue them a 1099 or not. So that's why you have to get the W-9. If someone has corporation in their name, you can kind of assume that they're a corporation so that you don't need to 1099 them. So I do let that one slide. The one caveat to this is if someone provides legal services for you, the IRS does not care what type of entity they are. You 1099 any law firm that does legal services for you. So if they're a corporation, you still 1099 them. Those are just the nitty-gritty basics right there. There's a new form 1099 NEC. This is non-employee compensation, and this is where these payments are reported. Those are due January 31st. The previous form was called the 1099 miscellaneous. This still exists, but the majority of what this is used for your type of company would be if you pay rent somewhere and if you have royalties. Those are the two common things that anyone I have has on that form, also due January 31st. So that's just a total overview basics. We have cheat sheets that are in here for more detail to really show you like, okay, is this advertising? That's a good one that trips people up. Like that is something that gets reported. And then this also shows like things that you do not need to report. So it's a lot more detailed than people realize. They kind of think like, oh, if I have Jamie doing some work for me, like, okay, that's obvious, I'll 1099 her. But like me, if you would pay my firm for something, you would have to 1099 our firm because we're performing a service to you, even though we're a company. So that is the overall basics of 1099s and the importance of them. Does anyone have 1099 questions? Because this ends up being a hot topic a lot of times.
Yeah, I have questions about this, but there was something on your last slide that may have been helpful for me because I can't figure out when to send these, especially, I'm going to say for food and meals, especially during COVID when those food and meals get delivered in catering trays, for example. Is that catering or is that just delivered food? But more importantly, I see at the bottom it says payments made by credit card are not reportable. Does that mean if I'm using a credit card to pay a vendor, I don't need to get a W-9? Because I find the W-9s are harder than the 1099s. Once I get a W-9, I can do a 1099. But
Yeah.
I don't want to ask every single vendor. I don't ask Home Depot for a 1099. They're not really services, so or for W-9. But I noticed that credit card thing, and I didn't know about that one.
Yeah, so if you are paying someone solely by credit card, and the other thing that's actually not on here that's in that realm is if you use PayPal as a business account, those 2 times are when you actually do not need to send a 1099 for those. So if you know you're always going to pay this vendor by credit card, then you're fine. You actually will not need to 1099 them at any point. And also just think of someone like a Home Depot or just figure anyone who's really a corporation type thing like that, you wouldn't need to 1099 them. And based on services too, like really make sure it's services. Catering is one that actually does get 1099. So yeah, there is that fine line, like delivery, like does that actually get 1099? I mean, a DoorDash or something like that, that's going to be a corporation anyway. So that like helps us eliminate that easily. But if you just truly have like XYZ caterer down the street doing an event for you guys and they're going to deliver everything, it's highly likely that you would actually have to 1099 them.
Thanks. I think about, some of the franchisees, whether it's Qdoba or Panera, if they deliver a meal, they have a different division called catering, but I don't know if it's their corporate office or a franchisee's business that we're paying.
Yeah, I think at that point I would probably be a little more lax on that kind of thing. I would think I would go more towards like the real like cater jobs, not like those type franchise places overall. I think you could be a little safer with that. Any other questions? That was like actually the basis of what I had. Just tried to keep it basic for the group, but really am open to discussion. And I mean, with my relationship with Pennovation and really just the startup community overall, I am very open to being a resource for random questions. You don't have to feel like that means you're committing to working with Stephano Slack. That's not how it works. I truly believe in like giving back to the community and just helping people get their business started. And a lot of times it is just something I can answer quick for you. So just always keep us in mind in terms of just any random questions you have is fine. But I'm still here available for questions if anyone has anything.